Hey traders, welcome to Charts and Coffee. Great to see everybody. Happy Friday. All right, so, I guess it depends on where we're looking. This morning, I was looking at the markets going into the Asian session close this morning, which would have been about 4 a.m. Eastern. And shortly after the Asian market close, especially in the Dow, so here's your Asian market close right here. And shortly after that close, wow, we've seen really a pretty dramatic move. Now, the first thing is, are we seeing it across multiple markets? The fact is we're not. Tech is probably going to be fine if we see that whole work from home, COVID lockdown. Definitely not the narrative we want to hear, but it's very likely we're going to see that. Tech will be far more resilient, and that overall it's the Dow and even the S&P that are going to take it on the chin. One of the trends that is kind of interesting right now, and not something that I'm really pleased about in terms of the weakness, but that's financials right now. I'm not saying we're seeing rotation, but if rotation is typically something quite strong, seeing profit taking in a more sustained pullback as something else, which was a laggard, is benefiting now from newfound money and attention. I wouldn't call this rotation in that regard, but I am looking at two of the sectors that have been the best to trade in terms of following the trend for the better part of a month and a half, 2 months, as we kind of close in on the end of November. And these two, which have been exceedingly good to me personally in terms of sticking with that trend, these are rolling over. So I know on a day like today, it's just going to be having to sit through a more sustained or more pronounced retracement, and then start to ask myself, what does this really mean to the trend? And if I know that trends typically want to continue, not reverse, and that a retracement and a reversal, yes, it might be a squiggly line between the two, but they're not the same. What I would say then is stick with the paper cut levels, don't presume a reversal, and remember that if the narrative is lockdown again, we kind of have the playbook for that. We just need to see that those corners of the market are responding in kind. So you can see what happened to crude here. And I will say this is not, and this is where news and trends will butt heads. Is there anything in terms of the trend that's been carrying crude oil higher that has unraveled? Actually, no. It's news now, and as we see the lockdown narrative talked about and actually happening in certain corners of the world, the presumption is we're going to see less demand for crude. And so that's what we're seeing here on crude oil. So these are things that I don't think you can plan for. Clearly, to have been short, say the last 4 to 6 weeks, waiting for news like this would not have been necessarily profitable because of just how much the market continued to climb. But on the flip side of that, this is why we have stops. This is why we have paper cut stops. This is why we love options on these ETFs or options on the futures, because it's easier to quantify risk. And when you do what I like to do, which is cash account, long call, long puts, my worst case scenario isn't really 100%. That's very rare. That should really never be where the stops should be placed on a debit, right? When you're focusing on long call, long puts. But, worst case scenarios usually are maybe 50, 60%. And I usually don't like to stick around for that. So as long as you're position sizing with that in mind, and position sizing according to not how much can I make, not about, swinging for a home run, but asking yourself, if I get stopped out, what's it going to cost me? So, days like today are really good examples of why it's so important to think about the risk side and why it's so important to talk about markets that aren't necessarily going in our favor when they have been for such a long period of time. All right, so let's kick it off with the questions. First off, I was just checking out the different banners. I don't know that I love that banner. Let's see here. That might work. Yeah, we'll go. There we go. So, Michael, good morning. XLF. Yeah, XLF is going to be one of those corners of the market that's been rolling over pretty significantly. Now, remember, when I send out the alerts, I send out alerts that are aggro, aggressive, moderate, conservative. We do have levels down in this area that are conservative. And I think we're going to open below those actually. However, having said that, remember the risk, right? Remember the risk from each level. And I think it's really important when you scale in, when you're open to scaling in. And our conservative trigger was, what was it, 30, like 39, 35. So when you scale in, remember 39, 35, we're not even really looking at a full 50 cents of heat in terms of the underlying quite yet. Who knows how the day is going to progress. But remember that if the aggro has lost that premium threshold, cut that number of contracts loose. Moderate, ditto. So you might end up at some point in your trade where all you're left with is moderate and conservative, or just conservative. And that is okay. I treat each level as an independent risk scenario, because think of it this way. The way that I teach you all to scale in, each level, each trigger has its own price for the option, which means I'm not managing an aggro the way I would conservative, because the cost basis was different, sometimes dramatically different. So that's what's going on XLF. As far as XLE, well, remember, you're going to see crude oil get whack-a-mole as these shutdown narratives persist. And as great as these markets have been to us now for, like I said, the better part of almost 2 months, they're going to get hit harder because the touchstone market for energy stocks is crude. So that's the risk. Now, was this something that, again, in the context of the overall movement higher, I will always remember this. And we had a video on, I think it was Wednesday. Yeah. Where I talked about how do we manage trades that don't go in our favor? And I think it's really important to emphasize. And if you want to catch that video, it's at the Simpler Trading YouTube channel. I believe it was Wednesday's free video. Remember, we're not talking about a chasm of risk from here or here. We don't buy higher highs, right? We're buying pullbacks. So as the market pulls back to here or here or here, or, wherever that our levels are, that's, where we're looking at a certain percentage of risk. Our cost basis is lower on the pullback as opposed to the momentum higher. And so one of the easiest ways to reduce risk is reduce cost. And so it's not, today is not about, oh my gosh, what's the narrative, or oh my gosh, where's the buy? Today is a day where we look at the corner of the market that is the least fun. It's probably the corner of the market that we like to think about the least. But that is, how am I managing my paper cuts? The market's not out to get me. The market, none of this is personal. If you all haven't read a great book and you want a great one for, gosh, this time of year is so perfect for this. It's Don Miguel Ruiz, The Four Agreements. That's been a book that I remember I bought for my mom and I probably over 20 years ago now. It's a classic, and probably one of the most gifted books that my mom and I, my mom loves to give books away, so do I, that we give. And if you haven't read it, read it. And it's so important because it works for traders too. Do your best. And my other favorite is, it's not personal. It's never personal. So the more that I can remember, this market's not out to get me. Did I do my best? And then I take my paper cut. And paper cuts are so important because the damage done to the account is minimal. And psychologically, the damage done to our trading mind is also minimal. It's so important. So I hope that helps. And so, yes, it's not about, I'm not really going to be thinking opportunistically today because I don't know what shenanigans are going to unfold over the weekend. Monday, we can see Sunday evening, we can see what kind of mood this market is in. Remember, we're going into a holiday weekend in the US. So I don't mind being a little bit more patient here in the next few days. I think that when I look back, and I have to do this too, I look back on September trading, even August, September, and most of October, it's actually been a really good run. And so it's so easy to get down on ourselves when most recent trades haven't worked out and forgetting that the last 60 to 90 days were pretty steady climbs in our P&L. We had losses, of course, but overall the trajectory was pretty decent. So now I got to ask myself, is it okay to sit maybe flat or with fewer positions for another week or so? Absolutely. Absolutely. Be comfortable with saying, I'm not sure what happens next, and I'm not sure I want to put my capital in harm's way while we're sorting that out. Okay. So I'm not saying that these may not look good on pullbacks. The level that I'm going to tell y'all to watch for the most part is probably the 55 exponential, but don't feel that this sell-off may be done. If we get more of this narrative ramping up over the weekend, what Sunday's open and Monday's action is going to look like. So I don't mind keeping a more defensive approach today. Take the paper cut, free up the capital, free up the mental capital, and go for there. Now, not everything's getting stopped out. I tend to kind of focus on the risk. I like talking about days that I get stopped out a whole lot more than when I hit my profit targets. Why? Well, one, luckily, for every 10 trades I take, my win rate's somewhere between 60 and 70%, usually closer to 70. The other thing is losses and learning to take them is how and when you turn the corner as a trader. Taking profits, let's face it, that's easy. Where the wheels fall off the wagon is the part of the conversation that nobody likes to talk about. Traders lose. Of course, I don't believe in a 50% win rate because that's really no better than flipping a coin. I think we have tools and strategies that give us a better edge. But I think a 60 to 70% win rate is pretty good. I will tell you this, way above 70, not good. You can have too high a win rate, believe it or not, because that has something to do with targets and entries and risk. But not everything's falling apart. And actually, some of this weakness is leading into our more conservative zones. I just want to emphasize, it's okay to put your risk, kind of put your risk covering hat on and say, look, today's not necessarily a day for opportunity, but rather just sort of cleaning up the book of trades. Uranium's looking pretty okay. Yeah, we have exposure to uranium. Andrew, I like it. It's been in the zone, and we like the buy. Double green in the wave. You know how I roll. That works for me. What's a good broker that lets you trade on margin? Sweetness, I don't trade options on margin really much at all. What I would say is, gosh, I mean, I don't have a favorite, but we have Thinkorswim, Tastyworks, TradeStation. Some of when it comes to futures, you've got to trade on margin, of course. Infinity, TradeStation, and then I don't trade options on margin, hardly ever. I do have an option margin account, but I hardly ever use it. So, and when it comes to futures, you've got to trade on margin. But it's the same brokers that I think we talk about a lot here in the Simpler community. And then the cool thing is when you're in the community, you can ask your fellow traders and say, who are you trading through? And do you like it? Do you like the fills? Do you like the platform? Do they have an online and mobile app? So that's what's so cool about having the community, because this way you can ask other traders, hey, how are you making out with this broker? Do you like them? Do you not like them? One of the things I will say is don't feel the need to have one broker take care of everything for you. In other words, some brokers have better charts. Other brokers have better order entry interface. Some brokers work with TradingView that I love to use. I can plug my TradeStation account into TradingView, get the data feed from there. Some brokers have great online apps. Maybe that's important. So it's definitely not one size fits all. UNG, is it over? Jimmy, it's close. I did a video last Friday saying this is the last dance, and it's still there. It's still the last dance with an expectation maybe of a halfway up move. So it's pretty much there. And crude oil, I talked about this, I believe, in the free video, definitely in the premium. And that is the transition that we've already seen occur in natural gas looks to be slowly occurring in crude oil, which is the transition from an uptrend to chop that still carries with it a slightly bullish bias. But I would say the trend, yes, is over. Are the buying opportunities over? Not entirely, but they're not as good as they once were. No doubt, right? The quality of the opportunities in the non-trending environment are far inferior to the move higher in terms of double green pullbacks into the wave when the grab candles remain pretty steady green. Definitely. All right. Next up is, and by the way, for those of you that are in trades and then we get questions about them in Charts and Coffee, remember that every time I look at the charts in Charts and Coffee, we're taking a fresh look at it. I don't want to talk about things that, well, I'm in it, so therefore all my analysis has to be bullish. Or I'm in this short, so all my analysis has to be bearish. It's a tricky thing. Whenever I look at them, I look at the charts as if in the back of my mind I don't have a position. So that way I can bring forth the most honest, up-to-date analysis versus being influenced by the bias of having a position and only wanting to recognize or acknowledge things that agree with my position. It's really important to think about the other side of the trade, especially when you're managing risk. All right, so next up is BABA versus Amazon. I wouldn't touch BABA right now with a 10-foot pole. Or Chinese stocks in general, I'm just not interested. Amazon, I'm really not interested in Amazon, quite frankly, yet either. We do have Amazon in a better uptrend, and I don't mean because of today's candle, not at all. Amazon was 1, 2, 3, 4, 5, 6, 7. Yeah, this area in Amazon, not my favorite. What I do like, and this is absolutely connected to Amazon, I do like XLY. Number one weighted stock is Amazon. So I'm really not looking at BABA. I'm not looking at the K-Webs. I'm not looking at MCHI, leaving Chinese stocks, Chinese internet stocks alone for now. Certainly not looking for a low to buy into. Amazon, I think I like that XLY idea of including Amazon, inviting it to the party, but making sure that it's just not about Amazon. And anytime I see a market do this, hey, kudos to anybody who's in it, but I will not engage the market like this. By the way, who benefits from lockdown? You guessed it. So all of a sudden we're gonna, grab our playbooks, right? Start cracking open our playbooks and say, okay, when was the work from home? Which ones did I play? And we start thinking about the previous setups we had when this narrative swung back around to, unfortunately, lockdown. Yeah. So that's where I won't chase this higher. Yeah. The setups were probably pretty valid through 11, 10, 11, even November 12, but I won't chase it higher. All right. Next up is, what was the name of the book? The 4 Agreements by Don Miguel Ruiz. And let's see. I really enjoyed the 3 questions too. I have the down there in my bookshelf. I'm looking at it. The 3 questions I actually enjoyed as well. Yeah. So, but the 4 Agreements was the first one. I will tell you, his son. Now, someone said, "Okay, Rock, pick your favorite." I actually like the 5th agreement. The 5th. His son wrote the 5th agreement, but discerning, trust, and discerning, and he recapped the first 4. And maybe it's a difference in age, but I really liked the way that his son recapped the first 4 and added the 5th. So I'd have to say my favorite, even though the 4th agreement was the first one, I'd have to say my favorite is the 5th agreement. So check them out. You can't go wrong with any of them. All right. So next up is, um, hang on here, gang. Let me catch it up. Oh, we're just about out of time. Um, do I like KRE? KRE has been a better performer than XLF. So yes, you want to stay opportunistic somewhere. We're looking at a pre-market 72.77 on KRE, which puts it below the 21 EMA. There could be an aggro setup waiting here. So my folks in live trading, my folks in the mastery, yeah, we're going to look at an aggro level in KRE. KRE has been outstanding to us. I mean, we've been in KRE since back in here. So yeah, you bet I'm going to be looking at KRE. But remember, XLF has been struggling. That's your financials. But remember, KRE is weighted in a completely different way than XLF in terms of the individual stocks within it and the composition. It's not a high concentration weighted ETF. So Don, awesome. Yes, it is 1000% on the radar. All right. So then next up is, XLF and XOP. Is it dead money? No, it's money that's transitioning from a trend to chop. XOP is another one that's on my radar today. So when I look at, hang on, I got my little journal that I like to write in. So I put a number of stocks, and so what I'm looking at are names that are pulling back in this weakness where we aren't seeing sort of the trend, the structure crumbling. So yeah, those are two of them. But again, I'll probably go in, if at all, definitely on the radar. Maybe it's a Monday trade, or we'll go very small aggro position sizing. I don't think it's dead money. I just think it's pulling back. But remember, we want to stick with the trend that was. So it's either flat, don't do anything, or maybe very cautiously, very prudently long. And so I like KRE better than XLF, and I do like XOP better than OIH, and maybe even going forward, mildly better than XLE. Now, one of the reasons KRE and XOP are so different from sort of their cousins, if you will, like XLE to XOP or XLF to KRE, is both of these stocks are not high concentration weighted. So all of a sudden, if we're seeing a lot of volatility, it might make a lot of sense. We'll be talking about this today from 3 to 4 o'clock when I kind of wind the week down for the closing session. So we're going to talk about non-high concentration weighted ETFs in an environment like this. And it does make a difference. You'll notice that XOP is, relatively speaking, more stable than XLE. You'll notice KRE, relatively more stable than XLF. Hope that helps. All right. And as always, thank you for joining for Charts and Coffee each and every morning, 9 a.m., 9:20, right here on the Simpler Trading YouTube channel. I do believe we're going to start releasing this in podcast format sometime either later this year or early next. So, heads up, we'll be expanding a lot of what we're doing here with Charts and Coffee. And this has been a little pet project of mine. I'm really passionate about it. And I'm so thankful that you all have been as receptive and just such a great part of our caffeinate and dominate community. So we need some swag for Charts and Coffee next year. Maybe. All right. Be good to each other. Check out the 4 agreements or the 5th agreement. You will not be disappointed. Have a terrific weekend. I'll see some of you for the close today. Be good to each other. Have a terrific weekend. And I'll see you on Monday.